Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Welcome back. Thanks for tuning in. Broker Daily Uncut. I'm very pleased to welcome back my co-host, Eva.
Hello, hello.
Back from Vanuatu.
Yes.
You've got to stop
great.
breaking records with Finny.
Yes. It was good. It was good for the team, good break, and ready to finish the year now on a strong note.
It's kind of a tricky time. I don't know what the timing was for you guys going. You've obviously got to go at some time, and when you're a busy brokerage, you're busy all the time. I would imagine that the team are in the midst of that sort of scramble for, sort of the run up to Christmas. But it's good that you guys got a chance to have a break.
We've got a really good team in the Philippines helping us get things moving while we're away. We did have to do a bit of work as well to make sure everything was smooth, but overall was good break. Yeah.
It's interesting time of year always. You're sort of at the peak point of the spring selling season, and
we see that,
regardless of what's sort of happening environmentally, there's always a lot of heat in the market. Agents are busy. It's probably the area where there's the most buyer and seller activity. Had a quick glance at the auction clearance rates. It was one of the most busiest weekends. You're sort of at a funny stage where, you're at sort of 70%. Excuse me. Auction clearance rates are sort of sitting at 70% across the board. Sydney and Melbourne around about that sort of 70% mark. Brizzy a little bit higher. Everything's sort of quite middling. But you're at that sort of interesting point. I sort of look at it now. You've got Melbourne that's horribly underperformed for a number of years, and you get the sense of that pent-up momentum, but you're not seeing it really taking place. You're not seeing sizzling hot auction clearance rates. It's a bit of a sort of stop-start market. Everyone expects it to go. But you've had the government incentives that have kicked in. They're now, you've got that sort of lower end of the market, starting to see that activity with first-time buyers. You've got the confusion, if you will, or the lack of clarity about where rates are going to go. We've had cuts this year. It was all going to be cut city moving forward.
We expected more, and then it didn't happen. And
What's the sentiments from your customers? I know you sort of primarily in that investor space. What sort of trends are you seeing at sort of borrower level?
I think everyone is still hoping for a cut. I would say though that there's more and more signs showing that there might not be another one.
Well, yeah.
Not now, not next year, and that might be finished for this cycle. And I think people are getting, used to the idea, and just trying to make sure, okay, well, am I comfortable at this level of borrowing, or can I do a bit more, or should I actually slow down a bit?
You got two sides of the coin, of course. You've got people buying property. You need somebody to be selling a property unless it's a new build, and seller sentiment is just as important, because if I feel that it's not the right time to sell, I don't put my property on the market unless I have to. So you've got that sort of, and then it's sort of supply and demand type thing. But even if supply is tight, if the properties that are going on the market aren't particularly desirable, buyers sort of stand off.
Yeah, we see. I think we're seeing that as well.
Yeah,
and people holding off selling. Yeah. So it's I think it's a weird market that we're going to see next year. And it's going to be hard to predict what's actually going to happen, because at the same time the scheme has pushed people to get back in, the rate cut have pushed people to get back in, and at the same time there's people thinking, well, they might hold off as well. So,
but I guess as you say that borrowers are starting to get used to the notion now that there probably won't be a rate. There's not going to be a rate cut this year. There may not be a rate cut next year. You said something interesting just off air, which I'd like to pick up. We'll pick it up when we come back after the break. Welcome back, Broker Daily Uncut. Eva and Alex with you today. Eva, you mentioned something, as I said before the break, just offline, which I wasn't aware of. But you said that fixed rates are starting to trend up.
Yes. So
when did that first?
Last week, actually, we've there's actually been a trend last month or so. A few lenders have dropped their variable rates out of the RBA cycle. So we've seen banks trying to be competitive and getting traction that way. As of last week, we've seen banks, lenders making the fixed rates, fixed term higher. So that's a trend we haven't seen in a long time.
Yeah.
And that says something.
Well, it does.
Yeah.
It would signal that the cost of the cost of funding for the banks indicates that
the anticipation is that it's going to go up. So we've had the discussion with our clients for a few months now that the fixed rates, even though they were not a lot lower than the variable, they were still a cut or two lower.
Yeah.
And that it could have been a good time to do it. And now the gap is closing.
When I first started borrowing, I would go for fixed rates. I believe very much in the surety around knowing what your repayments are, and there's a lot of merit in that. I haven't fixed rates for a long time. I think you get once in a cycle window where they're just a no-brainer. But it's you've probably had a bit of an opportunity to fix rates because it is looking like there's the variable rates are going to stay where they are for maybe 12 months, maybe longer.
Yeah, look, and for example, CBA is already saying there's not going to be any more drops in this rate cycle.
Yeah.
So if if you still have the opportunity to fix maybe a rate or two cut lower than where you are on now.
So let's look at that in a bit more detail. If they're saying there's not going to be any more rate cuts in this rate cycle, that means the next move will be up. Because that means it's the end of the cycle. If there's no more cuts in this cycle.
Yeah, we would stay flat for a long time.
Then that means,
that's one bank saying that.
That's one bank.
Yeah.
But that would indicate if there's no more rate cuts in this cycle, you could interpret that the next move, when the next cycle starts, is going to be upward.
Yeah, correct.
So I think what it means, however you want to interpret it, is that there's no more cuts on the horizon.
Yeah, so there's opportunities for some people, maybe owner-occupier especially, that maybe on a tight budget.
Yeah.
I guess the interest rate's around 5.3 on variable. There are banks offering 4.79
on fixed.
So it's like two.
For what, on a 1 year term, is it?
2 years.
2 years. I'll have one of those, thanks.
Yeah, so it could work for some people. Obviously, if you've got a lot of money in an offset, maybe not, but you could do a split loan as well. So yeah, it's a thing to think about because could be that it's only on the way up now. Remember those 1.99% was?
No, I don't, because I didn't get one.
Didn't get one. Long gone. But I guess that CBA offering that on the basis that the RBA said, "Oh, we're not gonna increase the rates for another 12 months or something." I can't remember what they said. But.
And I note that house prices have generally been moving upwards.
I think it was 1.1% this month, October.
I wonder what the lag is. I think that's totality data, and it's obviously you never really know what is selling last weekend and where the prices are because you have to wait. I'm going to guess they get their data upon settlement. I would assume so. So then you've got quite a big lag. It's always the last quarter, but the reality is it's probably places that were selling sort of before that.
It would take 6 weeks, 7 weeks before.
Yeah,
you see a real change. But look, from investors that are buying through buyers agents in the same suburb that I've seen like for a year or so, I can see sometimes massive difference in the price range for the same type of property. So even though I'm not a buyer's agent and I don't look at property price that closely, I can see it just from how many contracts are on my desk. I can see the difference in some suburb that we see often.
Yeah.
Yeah. So it's.
I was looking at some. I'm going to probably quote this very badly, but some of the latest research from Agile, which sends out a weekly bulletin, and I think it was more around. I think that older folk, 55 plus, were feeling less confident about their finances, and I don't think it really mattered whether they have a mortgage or not. If you're not familiar with the report, go check out Agile. They obviously run Broker Pulse, which is different set of metrics, but there's some quite interesting data coming out. Maybe it's because older people have been around through more cycles and maybe a bit more aware of where we're at the moment. I don't know. It didn't seem to affect younger sort of younger cohorts as much. But they've probably got, if you're a first-time buyer, you've probably got more to feel.
Yeah, and then they get the scheme. There's a lot for them
Yeah.
to get excited with. If you already bought property and you're 55 and you need a 30 years mortgage plus, it's not a great, outlook, right? If you think, 55, you get a 30 years mortgage with the price of property, it could be that, I guess I would understand if it's a feeling of like hopelessness almost. Like,
Yeah.
You need to be paying your mortgage quicker to feel okay about retirement.
And I know that the first home buyers grants, schemes, whatever, don't really lend themselves to your type of borrower, because your borrowers are investors and they're obviously not eligible for that. But have you seen anyone come through and inquire about that, or are you?
Yeah, we do see a few. We see like we do investors as a specialty, but there's always the son of somebody or the cousin of somebody, and they're just like our service. They're not hard to do. The scheme, and it gave a lot of hope, I think, for those young people to also go in suburb that they didn't target before. Yeah, because the price has increased, the salary threshold has increased, so it gives them a lot more option. But again, be quick for that scheme, because in 6 months' time, you'll be back to square one. And the 5% you need, you're going to be a lot bigger. Yeah. For the same property.
Just on your book, I'm just curious. Are you seeing? I'm just interested to sort of dig into where you're seeing inquiry coming in. Finley's got a good presence, got a good web presence. It's fairly searchable. Are you seeing new inquiry? What's the balance of new inquiries versus people on your book that are looking to buy again? Are you seeing a lot of fresh inquiry coming in, or is it really kind of established borrowers that are looking to go again? Or
because I guess because our investors are people that would just keep buying. Like pretty much all I do personally would be existing clients constantly coming back or passing on someone's details that they know. So we do have new inquiries, I guess, for the business. It might be, 30% of all new business we're doing. But I guess investors are always trying to find what's the next opportunity.
If you've got a portfolio and given the data that's come through from Cotality, and assuming that serviceability isn't getting any tighter, you're going to have investors that have, with an established portfolio, that have seen some capital appreciation in that.
You want to get equity and start again. I'm working right now with a client that I've had for probably 5 years, as long as I've been with Finney pretty much, and I think we are on his 10th property. So every 6 months we do something else. We're just going through again, releasing equity to inject into an SMSF second purchase. There's always something to do, and once we're going to be done with this, maybe refinancing for something else, or maybe buying his home this time, or whatever it might be. But somebody that I've worked for constantly for the last 5 years.
What's their? Are they a business owner? Are they?
No. Yeah.
So they're PAYG.
Yeah, PAYG.
And how tight are they on serviceability?
But sometimes by the dollar.
Really?
But we make it work somehow. We do something that would just help, like get a rent increase here, or close your credit card there, get a bit of a pay rise, every bits and bobs. One kid's turn 18. There's always something that changes the data. Yeah.
It's interesting. I think down to your personal risk appetite. I'm very aggressive and very reckless, maybe some would say, when it comes to investing. Well, you know how I purchase.
That's what I'm laughing.
But some people are wired that way, where they want to get ahead. They want to, you want to do it on the smell of an oily rag, and that's perfectly okay. Because it's up to the lender to decide on their appetite. And it's interesting to see that there is still margin if you are. We sort of, I won't go back down the path of talking about the lending. To sort of more complex trust structures.
When I say it passes by a dollar based on the bank's calculation, that has a 30% buffer here, another buffer there, obviously it's got more than $1 left at the end of the month.
Of course, it's a figure of speech.
Yeah. But it just keeps going, and it's going very well. And it's somebody that just doesn't use buyer's agent, does everything by himself.
Oh, really?
Studies the market. Exceptional. Yeah.
We'll take a quick break there. Eva, when we come back, there's again something that you sort of mentioned before when we were sort of sitting down to get started. And that was on the longer loan terms. Has been sort of a bit covered in the States with Mr. Trump. But I'd be keen to dive into that when we get back. Welcome back, Evan and Alex with you, Broker Daily Uncut. I'm keen to get some insights from you around longer term mortgages. I'm familiar with them. You know, when I first started borrowing, you know, sort of 20 years was sort of the typical term, and 25 years, and then 30 years felt like a big term for a mortgage. I think you've got people who don't understand the mortgage market that sort of will talk about people being saddled with debt for the next X number of years. We all know that loans turn over. It doesn't
It's
affect
4 or 5 years or something on average, yeah.
But I'd be, again, for my benefit, probably more so than people tuning in. What are you seeing? How many lenders are in the market for longer term loans, and what are they looking like? Are we looking at sort of 40 year? How many are offering 40 year terms now?
The one on top of mind would be a Pepper. We've got Eubank, and just maybe a month ago, Great Southern Bank, I think, just came to it.
Okay.
A month ago. Look, it's not a lot of banks doing that, and most people don't need that. I think it's a great tool, though, and I've done this for investors where the servicing is tight.
Yeah.
They know they're going to sell the property, or they pay interest only anyway. It's not the point to repay the mortgage within 30 years.
So just on investors, they're going. I can understand from a P&I perspective that a longer loan term reduces the principal, right? That's the simple.
The principal repayment every month.
Principal repayment. It's not going to affect the interest rate, but the principal goes down, therefore your monthly repayments are less. But if you're an investor on interest only, do you get a 5-year term for interest only, or do you get a longer term for interest only?
No, it just that would be a pure servicing purpose.
Just servicing.
Yeah, because even though you go on interest only, the bank will say, well, if you go on interest only 5 years, you got 25 years to pay the mortgage, and we'll assess you on that. If you take 40 years loan, you got 35 years. It changes how much you can borrow. No one's going to get the mortgage for 40 years. They're going to do something else.
Sorry for everyone tuning in for my ignorance. It's probably people sitting there probably shaking their heads. But that's okay. That's
there can be a game changer. And I've done.
So it's a serviceability. It's a big serviceability
and
issue.
I've had a lot of clients actually telling me, well, I know I'm stuck. I just want to think an opinion. Well, if you're happy to do that, then
what do your customers think though? Because you obviously do this on a daily basis. I've got a reasonable understanding as an investor. But for people do borrowers have fear of taking on a 40-year loan? Do they understand how it benefits them?
Yeah. So when they are an occupier, so I'm talking investor here, an occupier, and if it is a servicing issue or they think they can't afford the repayment, we do give a lot of education on. Okay, your monthly repayment, the minimum is $2,000, and it's going to take you 40 years to repay your mortgage. But let's set you up for an extra $200 a month. That will actually just compensate the difference, and you will finish to pay your mortgage in 30 years. Yeah. No one is stuck for 40 years. You can always pay off the loan. You can always, refinance. Most loans these days are like 4 to 5 years, I think. It's quite short. Yes. So as long as people know they're not stuck in there for 40 years, and it's not like in America, it's like a 30 years fixed mortgage, right? Where people don't refinance as much as here. I think once they know that, and they know if they make a bit of an extra repayment, it would be the same. But if a month is a bit tight, you don't have to make that extra repayment. Then they're like, actually, you know what? That gives me flexibility. Let's go ahead with that.
I think for borrowers, it's a lot easier to switch up. For brokers, you obviously face the same situation. In terms of churn, in terms of loss of sort of clawbacks, in terms of upfront. But it used to be very hard to switch going back, 20 years ago, 25 years ago. Now I think, sort of various governments have made it a lot easier for borrowers to switch. That's interesting. I'm going to, before we round off, very general sort of question. Which lenders are you seeing in market at the moment? Who are you seeing with an appetite, particularly in your particular area? Understand that it's, in the investment side of things. Who's in market? Who are you finding easy to deal with?
It's been really slow lately, I must say, everywhere.
Yeah.
It's taking longer to get things done. With Macquarie recently stopping trust lending, we can see a lot of them a bit more careful about, it's trust application, how are we going to assess that? So it does have a bit of consequences there. I'd say they're all quite actually hungry for business, and there's competition there. It's so busy that it takes longer to get through.
So it's really about a turnaround time type thing.
Turnaround time is an issue right now. it is.
I'm not going to jinx it because the last time I talked about a lender helping me out with my home loan,
It didn't go ahead.
it fell apart.
Oh no.
So I'm making my first SMSF purchase. I'm not going to jinx the lender.
No.
When it's done,
yeah.
I shall talk about the lender that's that Rebecca's.
And actually,
working with.
SMSF lending is a space right now with so much competition. It's so
Yeah,
aggressive
yeah.
to get business going.
I've watched my shares. You know, I was in the UK 3 weeks ago, and I looked at my share portfolio, and it was up 70%.
Yeah, not today.
It is now, and I've got particular again. My shares are not dissimilar from my risk appetite for property, down to about 30% up. I've lost a huge chunk.
Yeah.
And going through this SMSF purchase, I wish that I'd sold all my shares, and anyway, I didn't do.
Yeah.
But anyway, when I talk about when I've got this, I'm making my first SMSF purchase. I can't wait to get out of the stock market, put my money in property. But we'll talk about that once it's approved. Once the deal is done. I've got about another 3 weeks settlement. So
yeah, right. Quick.
Great to have you back.
Thank you.
Eva, always great catching up. I love the chat. It's mainly for my benefit, but I hope hope everyone else tuning in's got value. Please don't forget to check out the latest news. It's always there on brokerdaily.au. We'll catch you next week.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.